Segment 1. The cartel that thought it ruled the world. There was a time when a single decision made in a quiet room in Vienna could shake the entire global economy. That room belonged to OPEC, a coalition of oil producing nations that understood one simple truth long before the rest of the world did. Control the supply of oil, and you control everything downstream: industry, transport, inflation, and ultimately political stability. In the 1970s, this wasn't theory, it was demonstrated power. When OPEC restricted oil supply during the oil embargo, Western economies didn't just slow, they panicked. Gas lines stretched for miles, inflation surged. Governments scrambled. That moment cemented a perception that would persist for decades. OPEC's, what, OPEC's, OPEC was not just a producer group, it was the central command of global energy. The logic behind its power appeared structurally sound. Oil demand was inelastic in the short run. Economies couldn't supply switch off oil consumption. At the same time, supply was geographically concentrated. A handful of countries, particularly in the Middle East, held the majority of easily accessible reserves. This asymmetry created the perfect condition for cartel behavior: coordinate output, restrict supply, raise prices, and extract rents from the rest of the world. At the center of the system stood Saudi Arabia, not just as a member but as the swing producer, the only actor with enough spare capacity to increase or decrease output significantly in response to market conditions. This gave OPEC an enforcement mechanism. If members are cheated by overproduction, Saudi could flood the market, punish them through price collapse. Control wasn't just theoretical, it was teeth. And beneath this structure, the seeds of decay were already present. The cartel required discipline among members whose incentives were fundamentally misaligned. Each country depended heavily on oil revenue to sustain its domestic economy and political stability. That dependency created a constant temptation: produce just a little more than your quota, capture extra revenue, hope others maintain discipline. In game theory, OPEX was a repeated prisoner's dilemma with high stakes and weak enforcement. The cracks widened over time. Smaller producers facing budget deficits and internal pressures quietly exceeded quotas. That trust eroded. Compliance became selective. Publicly, the cartel projected unity. Privately, it was a negotiation battlefield where every member tried to maximize its own short term gain. At the same time, global demand began to evolve. Industrial economies improved efficiency. New technologies reduced oil intensity per unit of GDP. While demand still grew, it became less predictable. The unpredictability weakened OPEC's ability to calibrate supplies precisely enough to maintain stable prices. Yet for decades, none of this seemed enough to break the system. Oil prices still reached to OPEC announcements. Markets still watched Vienna. Analysts still treated the cartel as the primary variable in global oil pricing. That was the illusion. Because while OPEC was busy managing quotas and negotiating internal discipline, a structural shift was forming outside its control. One that would not challenge the cartel directly but would instead make it increasingly irrelevant. The shift didn't begin in the Middle East, it began quietly, technological, and most importantly, decentrally. Segment 2. The Fracture. Segment 2. The Fracture. When control slipped out of the room. The collapse of control didn't come from rebellion inside the cartel, it came from irrelevance imposed from the outside. While OPEC was negotiating quotas, a different kind of producer was emerging: one that didn't attend meetings, that didn't respect quotas, and that didn't require coordination. That shift centered in the United States, and it was built on a technological foundation: hydraulic fracturing and horizontal drilling. Together, these unlocked what had previously been inaccessible: shale oil. At first, it was dismissed. High cost, complex extraction, and uncertain scalability made it look like a marginal addition to global supply. OPEC treated it as a no noise. That miscalculation is where control began to slip. Shale introduced a new, completely different production logic. Traditional oil projects, especially in OPEC countries, operated on long cycles: massive upfront investment, long development timelines, and slow responsiveness to price changes. Once production starts, it is difficult to adjust quickly. Shale reversed this. It was modular, fragmented, and fast. Individual wells could be drilled and brought online in months, not years. Producers could ramp up or shut down operations based on price signals with unprecedented speed. The result was not just more oil, it was a new kind of market behavior. Instead of a centralized cartel controlling supply, thousands of independent farms began reacting to price incentives in real time. This is where OPEC's model broke structurally. When OPEC cut production to push prices up, The logic was simple: reduce supply, higher prices, increase revenue. That logic only works if supply outside the cartel remains relatively fixed. But Shell disrupted that assumption. As soon as price rose, Shell producer increased output. New wells became New wells came online. Capital flowed into drilling operations. The supply that OPEC had removed from the market was replaced not by a coordinated rival cartel, but by a decentralized swarm of producers responding to profit signals. This created a feedback loop OPEC could not control. OPEC cuts, prices rise, shale expands, and supply increases, causing the price to fall. OPEC loses leverage. The cartel was no longer setting the price, it was reacting to a system it didn't control. The critical shift here is structural, not just economic. OPEC's power depended on scarcity and coordination. Shale introduced abundance and fragmentation is the enemy of cartel power. You cannot negotiate with thousands of independent actors. You cannot enforce discipline on a system that is driven by market incentives rather than political agreements. There was an attempt to respond. In 2014, Saudi Arabia made a strategic move. Instead of cutting production, it flooded the market. The objective was clear: drive prices down far enough to make shale productions unprofitable, force bankruptcies, and restore OPEC's dominance. It partially worked, but not in the way they expected. Some shale companies collapsed, capital tightened, but the industry adapted. Costs fell, efficiency improved, technology advanced. The break-even price for shale dropped significantly. What was once considered a high-cost source of oil became increasingly competitive. Instead of eliminating the threat, OPEC accelerated its evolution. Now the cartel faced a fundamentally different opponent, not a fixed competitor, but an adaptive system. Every attempt to manipulate prices. Every attempt to manipulate prices triggered a response. Every move created a counter move. Every model of controlled, centralized, coordinated, predictable was being replaced by something far more unstable. And instability is the one condition in which cartels fall. Because cartels require predictability, they need to anticipate demand, estimate supply, and calibrate output accordingly. When the system becomes reactive and decentralized, that calibration becomes impossible. OPEC was no longer the architect of the market, it had become one player among many, and the more it tried to assert control, the more the system pushed back. Segment 3: The Flood, when supply became uncontrollable. What shale started, global expansion completed. OPEC's weakening position was not just about the disruptive technology in the United States. That alone would have been manageable. The real structural collapse came when oil supply stopped being geographically concentrated and began spreading across multiple competing regions. New producers entered the system not as coordinated allies but as independent actors with their own incentives, timelines, and strategic objectives. Pakistan expand sorry Brazil expanded aggressively into deepwater pre-salt reservoirs, unlocking vast offshore oil fields that were once considered too complex and expensive. Technological progress reduced extraction cost and increased output reliability. Canada scaled its oil sands operations, turning unconventional heavy crude into a stable long-term supply source. What while cost incentive these reserves While intensive, these reserves added a layer of supply that could not be easily removed from the market once developed. Meanwhile, regions like the North Sea, parts of Africa, even smaller producers began contributing incremental supply. None of these individually rivaled OPEC scale, but collectively they changed the structure of the market. This system crossed a threshold. It moved from a concentrated supply to a distributed supply. That shift has consequences that they go beyond the simple production numbers. In a concentrated system, coordination is possible. A few actors can align incentives, negotiate output, and influence price direction. In a distributed system, coordination breaks down. Each producer optimizes for its own revenue, often in conflict with others. This is where OPEC's model becomes structurally obsolete because its power depended on being indispensable. Once the market no longer needs OPEC oil as the dominant marginal supplier, the cartel loses its ability to dictate terms. It could still influence prices at the margin, but it could no longer anchor them. The second order effect is far more damaging than the first. As supply is diversified, volatility increased, with more actors responding to different signals. Political, economic, technological, the market became harder to predict. Price swings became sharper. Short term shocks had amplified effects. Volatility undermines strategic cartel. A cartel needs a stable environment to plan production cuts and expansion. It needs a relatively predictable demand curve and a controllable supply base. When both supply and demand become dynamic, the cartel is forced into reactive behavior. This is exactly what happened. OPEC meetings, one decisive, became increasingly symbolic. Announcements still involved markets, but they were less reliable. Traders began pricing in uncertainty rather than compliance. The credibility of coordinated action weakened. Even the expansion into OPEC plus, bringing the non OPEC producers like Russia, was a defensive move, not a position of strength. It was an attempt to rebuild coordination in a system that no longer supports it. But expanding the cartel introduces new problems. More members mean more conflicting interests, different fiscal needs, different geopolitical goals, different tolerance of price fluctuations. The coordination problem doesn't get solved, it gets multiplied. The underlying issue remains unchanged. You cannot centralize control in a system that has already decentralized itself. At this point, OPEC is no longer operating from dominance, it is operating from constraint. Every decision it makes accounts for shale responsiveness, non OPEC supply expansion, internal compliance risks, external geopolitical pressures. That is not control, that is containment. The global oil system has outgrown the structure that had once governed it, and the more OPEC tries to reassert authority, the more it exposes its limitations, because the real shift has already happened. Control has moved away from producers and into something far less visible, far less centralized, and far more difficult to dominate. Segment 4, the demand trap. When ground beneath oil starts moving. Up to this point, OPEC's problems looks like a supply issue. Too many producers, too much fragmentation, too little coordination. That's only half the picture. The deeper failure is on the demand side. Cartels do not just control supply, they depend on predictable market. Without it, every production decision becomes a gamble. Global oil demand is no longer predictable the way it once was. The shift is gradual but structurally irreversible. Start with transport. The single largest driver of oil consumption. For decades, the sector was locked into petroleum. There was no viable alternative at scale. That locking created demand certainty, which allowed OPEC to plan output with relative confidence. That certainty is eroding. Electric vehicles are no longer experimental. They are scaling rapidly, particularly in markets like China, where state policy, industrial capacity, and infrastructure investments are aligned towards electrification. Each additional EV doesn't just add to a new market, it subtracts from oil demand permanently. This is not a short term fluctuation, it is a structural substitution. At the same time, energy efficiency improvements are reducing oil intensity across economics. Modern engines consume less fuels per unit of output. Industrial processes are becoming less energy intensive. Even when oil demands grow, it grows more slowly relative to economic expansion. That comes from policy pressure. Governments, particularly in developed economies, are actively targeting fossil fuel consumption through regulation, carbon pricing, and incentives for renewable energy. Solar and wind capacity are expanding at scale, not because they can replace oil fully, but because they reduce future dependency on it. The result is a demand curve that is no longer stable. It is uncertain, political influence, and technologically unstable. This creates a strategic trap for OPEC. If demands were stable or growing rapidly, OPEC would just adjust supply and maintain influence even in the fragmented market. But when demand itself becomes volatile, every supply decision carries risks. Cut too much, you accelerate the transition away from oil by raising prices and making alternatives more attractive. Produce too much, you crash the price, damage your own fiscal stability. There is no optimal position. This is where the second order effect becomes critical. Oil is shifting from a growth asset to a contested asset. From For OPEC members, many of whom rely heavily on oil revenue to fund their economies, this transition is destabilizing. Their fiscal models are built on a long-term demand assumption that may no longer hold. This creates internal pressure to maximize short-term revenue, even if it undermines long-term control, which brings the entire system back to original problem, incentive misalignment. But now it's worse. Even before members cheated quotas because they wanted more revenue, now they may need more revenue to compensate for uncertain future demand. The incentive to defect increases, not decreases. This accelerates fragmentation inside the cartel as at the exact moment where external pressures are rising. And there is one more layer financial markets. Oil price is no longer purely determined by physical supply and demand. It is influenced by future markets, macroeconomic expectations, currency movements, and speculative positioning. Traders react not just to actual consumption but to forecasts, policy signals, and risk sentiments. This means price formation has partially detached from OPEC's direct control. Even if the cartel manages supply perfectly, prices can move based on factors it cannot influence. At this stage, OPEC is not just losing control of supply, it is losing control of expectations. And once expectations are externalized, driven by markets, technology, and policy, the cartel role shifts from dominant actor to reactive participant. The system has changed this logic, and OPEC is no longer operating at the level where that logic sets. If OPEC is no longer the center of power, then where did that power go? It didn't disappear, it relocated, but not to another control. The modern oil system is controlled not by a single organization, it is shared by overlapping systems, each controlling a different layer of the market. First, there are price responsive producers, particularly in the United States. These actors do not coordinate, but they dominate through responsiveness. They don't set prices directly, they absorb, react to them faster than anyone else. In a volatile market, speed becomes power. Second are geopolitical choke points. Physical flow matters as much as production. Strategic locations like the Strait of Hormuz or the Strait of Malacca act as valves in the global energy system. Influence over these routes through military presence, alliances, or geographic positioning translates into leverage that no production quota can match. Oil is one of the most traded commodities in the world. Future contracts, derivatives, and speculation flows shape price expectations continuously. From shale extraction to renewable energy systems, technology determines what is economically viable. It sets boundaries. Unlike OPEC, it doesn't negotiate, it evolves. These four layers production responsiveness, physical choke points, financial markets, and technology form a distributed control system. No single actor is dominated, but collectively they define the market. This is where OPEC stands today, not irrelevant, not insufficient. But it can still move markets at the margin. It can coordinate production among its members. It still matters. But it no longer defines the system. And in a system where control is distributed, the idea of a single dominant cartel becomes structurally outdated. And the world didn't overthrow OPEC, it just outgrew it.